Welcome back to Fast Money. Let's get another check on shares of Netflix, close to after-hours highs after its earnings report. The earnings call just wrapping up. Let's bring in Rich Greenfield, media and tech analyst at Lightshed Partners. Rich, great to have you with us. First impression of the call, what are the highlights here?
I mean, this is the flywheel, right? You literally create lots of content, you drive engagement, you get people so addicted, you're able to raise the price, have more revenue that you can then reinvest in more programming, drive more watch time, raise the price. It's a flywheel, and it is really working. And Melissa, what's really interesting is what's increasingly obvious is that all of Netflix's peers aren't spending enough money on programming. And if they have any hopes of staying in the streaming business, they need to spend a lot more money on producing movies and TV shows, or they're going to get left in the dust.
I don't know if that's going to happen. I mean, I don't know if they're going to be spending more money, Rich. So extrapolate out what the picture looks like in a year, even, when shareholders get fed up with lackluster streaming results.
You're asking the right question, Melissa, and I think it's what every investor should be talking about, because you've seen how reducing content spend is definitely having an impact. It's slowing down the subscriber growth, especially domestically, that you're seeing from, all of the traditional or legacy media companies. They're all having a tough time growing subscribers. And, what's really interesting, Melissa, I think when you asked about the highlights of Netflix, one of them was clearly the growth in advertising. 50% of new subscribers signups this quarter came onto the advertising supported tier in ad markets. And so advertising is working. But remember, you can't drive ad revenue if you don't have lots of watch time. If you're not watching, like you sign up for Disney Plus through Charter. If Charter, has Disney Plus on their subscriber base, but if you don't actually activate and use Disney Plus, there's no advertising to sell. Like, you need watch time. And so it just keeps going back to what really is most important to succeed in streaming is watch time. And the only way you get watch time is having a tremendous amount of content. That's what everyone needs to do. And if they don't, they all need to be rethinking what is their strategy.
Rich, watch time might be one thing, but the margin improvement is staggering over the last couple of years. And to me, that more than offsets any concern about slowdown in revenue growth or any of those things. Speak to that, because that to me was the missing piece.
I mean, look, Netflix is generating, $6.5 billion of free cash flow. You probably remember not too many years ago, I probably was on this, after earnings, and we were debating, is this company ever going to make money? This company's making a tremendous amount of money, and it's getting stronger and stronger. And sort of to Melissa's point, I think this is what's interesting. If the other companies don't really, start doing a much more aggressive battle, if they don't really compete, if they're unwilling to spend more money, that type of scaling of margin and profitability and free cash flow is going to continue scaling. And remember, what did Netflix tell you about the most important thing investors should hear about 25 is they're not going to show another 600 basis points of margin improvement. They're going to be reinvesting. They're literally putting their money into more content. WWE starts next year, right? They just did the NFL at the end of this year. They are moving further into live content, event content, and dabbling in sports. They are putting more money into this business to extend the lead and to meaningfully drive the advertising business. And that is going to just continue to increase their lead. And you start to wonder, how does the traditional sector, as they get into streaming and they try to be in the streaming business, how are they going to acquire the best projects? When you look at the relative strength of Netflix's balance sheet versus the peer group, that's going to be a big challenge for a lot of these companies as you look out.
Rich, it's Karen. Thanks so much for being on. I agree. I mean, everything looked fantastic. The only sticking point for me is valuation. So, it's been a premium valuation, as it should be, for a long time. But at what point do you think it's sort of everything good is priced in?
I mean, look, I think a lot goes back to, and I keep coming back to Melissa's question, if the others aren't really going to compete, you start to extend that lead and you start to reinvest and build stronger and stronger. And, look, that margin profile, the one line in the press release that everyone should be focusing on is they said we have despite there's only 100 basis points predicted in the guidance for 25, they said there's a long runway to go on margin improvement over the long term. And so is this a 35% margin business, maybe more over time? Certainly, ARPU is going to keep growing, not just from price increases, which, again, a lot of people were betting there'd be a price increase today or announced shortly. That is still another catalyst as you're talking about valuation. My guess is they raise price at some point over the course of the next 3 months because the content slate is one of the best it's ever been. So there's a big price increase, not a big, but there's certainly a price increase in the U.S. coming soon, which will be another catalyst for the stock.